Good morning, everyone. Today is Friday, the 4th of May. My name is Mel, aka Scientia Trader, and it's a fantastic privilege to be on a webinar with you today. This is something which I've, for a very long time, wanted to do, and it's great now to be in a situation where these webinars are going to be a weekly occurrence. It was very difficult actually trying to strategize what is the best way to approach these webinars, especially the first one. Many of you will probably be listening to this because you've either come through my Twitter or you've come through my website, and it was really difficult because the subject matter is so vast, my experiences are so vast, and I was always thinking, well, what is the best way to convey information in a way where I'm not rambling on for hours and hours and giving you the best quality information I can. What I decided to do today was freestyle it because I kind of felt, well, let's just see how the first one goes, and then if I can get your feedback and comments, then obviously I'll be able to make natural adjustments as I sort of go ahead with the successive webinars over time. I've entitled this webinar Transition because that's exactly the stage which I have been going through over the last year or so. I've been in the situation of trading for many years, and within that journey there's been different elements of that journey, peaks and troughs, frustrations, successes, victories, failures, and it's built me into who I am today. And regardless of what anybody says, regardless of whatever criticism one may want to throw in my direction, the way I think, the way I approach problem solving is all a direct result of my experiences. And so what I wanted to do today was give you a bit of an insight into some of the things I've picked up during this journey, and hopefully you'll be able to get something from this which may help you in your journey. One of the things which I just wanted to sort of emphasize from the outset is the fact that the strategy which I employ is not the end or be all of trading. There are many different ways to skin a cat, and in trading one of the things I've learnt is that there are many different ways to be successful, and that's one of the reasons why in trading you have people that are successful with fundamental trading, you have people that are successful doing technical trading, you have people that are successful following momentum strategies, you have people that are successful following Fibonacci strategies, you have people that are successful following stochastics, you have people that are successful in the area of options, you have people that are successful in the area of forex, equities, commodities, sports trading, and within sports trading again there are different areas, whether it's tennis, football, golf, horse racing. And so because of this vastness, I think it's really a reflection of who we are as individuals in terms of our makeup and our attributes. Everybody is different. Everybody has different ways of problem solving. Everybody has different ways of approaching things. So I just wanted to emphasize that the strategy that I employ is not the be all or end all. There are many other football traders out there who are earning a lot more than I do. Obviously that could be because obviously they've got a bigger bank that they're working from, which obviously has a big impact in terms of your returns. But what I'm trying to demonstrate is something that works for me. And as somebody who comes from a scientific background, it was very important for me to grasp a strategy which had a level of technical substance in it that I could actually resonate with. It wasn't enough for me just to take on a strategy where somebody said, yep, it works, try it, and you should win over time. For me, I needed to have a an understanding of certain principles and fundamentals which would help me, my mental state, to embrace it more rather than fight it. And these are some of the things that I'm going to talk about a bit further on during the course of this webinar. So, moving on. Before I move on, I just wanted to give you an insight into some of the individuals that have actually shaped my journey. Most, if not all, of these individuals have nothing to do with sports trading. And that's not to say that within sports trading there are not successful traders or people that I could have used as mentors. But you've got to understand, before I actually started sports trading, my interest was actually in stocks, and looking at stocks on the Nasdaq and S&P, and really looking to understand how successful traders are actually making a success out of trading on these particular exchanges. And so these people here are just a snapshot of some of the key people that have actually shaped my journey in terms of the principles and the fundamentals that they espouse. I don't necessarily trade in 100% the same way that they trade, but certainly in terms of the direction that they go with their trading, there's certain things that I've been able to pick up on and amalgamate it all into something that works for me. It's almost like a smorgasbord approach. So the top guy, Peter Brandt, he's one of the world's top traders in terms of equities. He actually was one of the individuals that was featured in the book Market Wizards, authored by Jack Schwager. And Peter Brandt, his legacy, his reputation speaks for itself. Another person, Dr. Van Tharp, again, is another guy who really has had a very profound influence in terms of how I trade, especially when it came to understanding the concept of risk-reward ratios and how that really has a significant influence in terms of your profitability. And Dr. Van Tharp actually was another individual that was actually featured in Jack Schwager's Market Wizards. Ross Cameron, again, is another guy who I follow quite a lot. Ross is basically the head of Warrior Trading. And what I liked about Ross was the transparency that he provided in terms of people being able to monitor his daily trading results. Too many times in this industry, educational consultants will speak about particular theories and concepts, and then you can never get to see whether what they talk about actually fulfills itself in reality. And one of the things that I've understood on my journey is that taking a theory and translating it into a reality is a lot more difficult than one can perceive, because of the fact that most of the time when you are theorizing, you're theorizing from a position of environmental perfection. Whereas when you are trading in reality, you have other things you have to contend with, which were not part of the original simulation, whether it's slippage, whether it's your internet going down, whether it's the fact that you're trying to trade on a particular match but then realise that Betfair for some reason have decided not to make it in play. And there's so many other parameters and so many other things you have to contend with. But what I like about Ross is he places his trades every day for people to see, and you get to see the good, the bad and the ugly. So you get to see not only his monster winning trades, but you also get to see his losing trades, and you get to see his reaction when he has losing days, and you get to see how he contends with going 3 or 4 losing days in a row. And it's so educational being able to see the contrast between losses, wins, losing days, winning days, and amalgamating that all into an idea as to how efficient a trading strategy is. And too many times I find that people on the internet who are showing their trading results are so keen and eager to show the monster profit trades or the monster profitable days. But when it comes to losses, they either go quiet or they tell you that they've had a loss, but you can't see what that loss amount was. And so you have a very distorted view as to how that particular trading strategy is actually doing in reality. So that's one of the great things I like about Ross. Mark Soberman, again, he's another giant figure that I absolutely adore. NetPicks have a tremendous reputation for drilling into detail regarding some of the statistical parameters that are necessary for you to understand whether a trading strategy is robust or not. They produce a lot of great material. I've followed them and learnt from them tremendously. And Akhil Stokes, again, he's another guy who, again, is very, very, very good, has a great reputation in the industry, has been around for a long time, and I really like his realism. He tells it as it is. And Charlie Burton, I would presume that a lot of you may know who Charlie Burton is. He was featured on a 2-part BBC documentary called Traders by the Millions. And again, he's a very successful trader who I've learnt a lot from in terms of particular concepts. So the reason I've put this slide there is because many times I get asked, who are your mentors or who are the people that have actually shaped your journey? There's others, but I would say these are definitely the key ones for myself. I'm sorry if my throat sounds really low. It just happens by sod's law that the very day which I'm going to do the webinar, I've got a bit of a cold. So if you hear a lot of spluttering and slurping coming from me, just be advised I'm trying to deal with the cold. These are some of the books which again have been quite instrumental. Trade Like a Casino is a giant in terms of content, because one of the key things that you will need to understand, if you haven't already, is how important it is to have an edge in trading, and even more importantly, that having an edge that is quantifiable. So not an edge where you're saying, yeah, I feel like I know what trades to pick based on a hunch or intuition, but having something that is measurable and quantifiable. And Trade Like a Casino, written by Richard Wiseman, was one of the first books I read, which really helped me to understand that if you don't have an edge, essentially what you're doing is gambling, because without an edge you can never really have consistent long-term success. Evaluation, optimization, trading strategies, Robert Pardo, absolute giant of a book. This really helped me in terms of the development life cycle I was going through in terms of trading, because one of the things that really impacted me, especially sort of 2-3 years ago, was what they call curve fitting. And sometimes you can actually curve fit your results subconsciously without even realizing what you're doing. This book was really, really instrumental in helping me to understand back testing, the advantages as well as the disadvantages of back testing, but also the importance of what they call forward testing, etc. So this really helped me to put together almost like a development life cycle of how you take a theory through to full implementation. Trading in the Zone, again, is a giant of a book by Mark Douglas, who unfortunately died, I believe it was 2 years ago. And this deals with more the psychological component. Again, this was something which I totally disregarded. I thought it was a lot of fluffy, esoteric stuff that really wasn't of interest to me. As far as I was concerned, it was just about finding the right strategy and being able to go ahead with it. But suffering some major disasters in terms of trading, I soon learned to realize how important it is as far as the psychological, mental component is, because as individuals we are emotional beings, and no matter how hard you try to reduce emotion in trading or try to limit your emotion in trading, There are going to be times where your emotions are either going to get the better of you. So you really have to learn how to control your emotions and how to respond, and also how to understand what your weaknesses and strengths are. One of my key weaknesses growing up as an individual was impatience. Impatience and lack of discipline. I always wanted things now. I always wanted things quickly. And there's a little story I wanted to give, which is when I was at the age of 7 years old, I remember going to primary school, and we went through a week where the subject matter was understanding growth. And one of the exercises we had to do, we were all given a very small flower pot with some earth in the flower pot, and we were given like an orange pip, and we were supposed to put the orange pip down into the earth and then take the flower pot home, and basically over the course of 2 weeks we were supposed to water the flower pot once a day, put it in a location where there was sunlight, and really the point of the exercise was that after 5 or 6 days you were supposed to see obviously a flower starting to spring up from the earth, which is obviously the formation of early formations of an orange tree basically. And so what did I do? Well, after 2 days, when I saw that nothing was happening, I started to water it 5 times a day. So here we are, we've been told, we've been given very clear instructions to water it once a day. Our expectations have also been framed, because we've been told don't expect anything to happen for the first 5 to 6 days. Yet here I am violating principles that I'm not supposed to violate. So after 3 or 4 days, because I'm overwatering it, nothing was happening. What did I do? I said to myself, well, it's not getting enough sunlight, so what I'll do when I go to bed, I'll turn on my side lamp next to my bed, and I'll put the side lamp in a position so it shines completely over the flower pot during the night time. Because my logic was, well, if it's getting at least a good 8-9 hours of light, it will speed up the process. Bottom line, what happened? Well, after 2 weeks, nothing came up from the earth, yet everybody else in my class was showing off and basking in the glory of the flower that had started to stem from their flower point. And I think this is really something that's plagued me throughout my life, which is impatience and discipline. So can you imagine going into trading as a form of employment with those particular weaknesses in your character? You would say it's also a recipe for disaster. So that's why the psychological aspect is so important, because it helps you to deal with character flaws, personality flaws, things from your past which can have an impact in terms of your decision making process. And then Market Wizards is obviously it's a renowned Hall of Fame publication where Jack interviews some of the world's best traders of all time, and the nuggets of information in there are just absolutely fantastic. So moving on, one of the key things which always was my Achilles heel, and I say this now because obviously looking back retrospectively, you have a much more measured insight into where you were going wrong. But certainly during my early days of trading, one of the problems for me was that I was always searching for high win rate strategies. Now, the reason for this was a number of things. Number one, I hated losing, very sore loser, and so for me, being able to get a strategy which won at least 70% of the time was almost like my defense against having to deal with losses. Now, whether you have a strategy which is 70%, 80 or 90%, you're still going to have losses. But what I was trying to do was find a strategy which actually minimized and limited losing streaks. And so I was constantly searching for high win rate strategies. And even when I decided that I would stop following other people's strategies and try and develop my own, I was still developing it on the principle that I need to find something that wins at least 70% of the time on a weekly and a monthly basis. And I used to find I would go through this cycle, never-ending cycle, where I would develop a particular theory, I would test it out, I would find that it won 70% of the time, sometimes even 80% of the time. And I remember the excitement I would have thinking that I'd actually found the Holy Grail. And I remember what I would do is I would then, test it over the course of a week or so. But then when I would actually go into a live environment, what supposedly was supposed to be a 70%, 80% strategy would operate like 50% or 60%. Sometimes I would actually start the strategy of in a live environment and immediately have 5 losses in a row. And there was so much emotional trauma I would go through, because basically I couldn't understand how there was such a disparity between what was happening in backtesting and simulation mode versus what I was experiencing in the live environment. And it happened repeatedly. And each time it was happening, what it was doing was actually chipping off a little bit more of my confidence in trading. And all of a sudden, and some of you may have similar feelings, but all of a sudden you start wondering whether number one, you're cut out for trading. Number two, you start to wonder whether this whole thing is just a scam. You even go as far as wondering whether there's some sort of curse on your life, because you can't understand why every time you try to do something in a live environment, it never seems to be the same as a testing environment. And so this was a tremendous source of struggle for me in terms of trying to grow as a trader. And I felt that I couldn't trade because of the fact that I just wasn't able to find something with a win rate to give me the confidence in terms of moving forward. And obviously this is also perpetuated by the fact that you would see a lot of people selling systems where they're promising 70, 80%, 90% win rates. And there was even one gentleman, and I won't name who he is, but he had a particular system, football trading system, where he said that it was 100% win rate. I believe it was something, or the concept was called football hedging. And the idea behind it was that you would make an initial trade, but if the trade didn't go in your favour, you would use some of the other markets almost to counterbalance the initial loss. And it sounded very plausible, it sounded very, very interesting, and it sounded quite exciting to know that you could have something where at the minimal or at the worst it's break even. I remember signing up for this and with all the enthusiasm and confidence in the world, only to realise that actually it wasn't everything that it was supposed to be. Number one, you can't use different markets to balance the loss from another market, because the exchange systems are so efficient in how they work that it's just not possible. And the way that it would work in this scenario was that in order for it to work, you had to, in most cases, wait a period of time for price to move to a particular favourable position for you to then take the counterbalancing trades. And what does that present? Well, it presents risks, because whilst you're waiting, something else could happen again, which then means that the market you are waiting on to come to your favour no longer becomes available. And so I used to find that a lot of systems out there conceptually, theoretically sounded great, sounded plausible, but when you actually tried to run it within a live environment, you started to see that there was a lot of issues. And what was quite interesting with this particular individual, somehow it worked for him, But I remember there was one time he came on the line with one of his a testimonial from one of his trainees, who was one of the best trainees, and this trainee had come on a line to talk about, you know, his experiences. And what was quite interesting, I remember somebody asked him the question, which is, well, how much are you making a month from it? And he said, I think he said somewhere in the region of about £2,000 a month. And for me, I thought to myself, well, here is a guy who is running a system. He's the best testimonial that the trainer can provide, and he's only taking home £2,000 a month. Something didn't seem right for me. Anyway, what I also realised was that the more I searched for high win rates, was the more I was actually exposing myself to a significant imbalance between the reward to risk. And this is something that is just it's just a fundamental fact and component of any exchange, whether you're trading forex or commodities or equities, or you know, if you're trading whatever the property that you're trading, exchange systems are set up in a way that as your win rate goes up, your reward to risk ratio goes down. And that's why, and that's possibly what causes a significant struggle for many of us, because we're trying to find, well, what is that perfect balance? And again, it also comes down to what is our personality type. If you're somebody that's continually searching for high win rate systems, then the truth is that you're probably going to be more going for systems where you're risking 2 to make 1, or you're risking 3 to make 1, or God forbid you're risking 4 to make 1. If you're somebody that has a lot more comfort with a low win rate system, then you're going to be risking 1 to make 2, 1 to make 3, 1 to make 4, but at the same time you're going to be more susceptible to higher rates of losing streaks. And so the eternal question is always, well, what is the right formula, what is the right balance? And that's something that really, I think, at the end of the day, comes down to who you are as an individual. What I'm talking about on this presentation is something that's based on my own experience. I can never say to somebody, well, you should always go for a 50% win rate or 60% win rate. But certainly for myself, I think I found a home of comfort with a particular win rate and a particular risk reward, which balances and manages to create profitable trading week in, week out, month in, month out. One of the things which caused me to actually start realizing that I needed a different approach to my mindset in terms of the way that I looked at win rates and risk reward was something I saw written by Peter Brandt many years ago. And I must admit, when I saw this initially, it really got my back up, because at the time I was somebody that was constantly focusing on high win rate strategies and thinking that was where the Holy Grail was. But this particular statement by Peter Brandt was a controversial statement. And what he said was, he goes, I'm going to be brutally frank from the start of this post. He goes, people who seek a high win-loss ratio do so because of their emotional and psychological inability to handle losing trades. Pure and simple. And he goes, sorry folks, the truth hurts. He says, trading is basically a business that's subject to statistical probabilities. A trading system that lives up to the claims of the scammers has an asymmetrical profile that is so many standard deviations away from the mean that it's not even worth talking about. However, he does admit in the last paragraph that he is aware of people that are able to be successful with a high win rate strategy, but he says these people are very, very few, far in between. These people are pretty much born with a gift to have found and worked something that really works for them. And this really got me thinking, and what had happened was obviously I had moved from football trading, not having much success, and then I was looking at trading in the financial world. And then I thought to myself, well, if I go back into football trading, why don't I start trying to apply some of the principles that some of these key individuals are talking about? Because I kept finding the same thing coming up time and time and again with people that were perceived to be the experts in the financial trading industry, whether it's Peter Brandt or Dr. Van Tharp or Mark Douglas or Akhil Stokes. They all seem to be the same thing, saying the same thing, which was that your win rate needed to be around the 50 to 60% range with a risk-reward ratio which is strongly in your favour. And so as I started to explore this more and more, I then realised the reasons why this was such a profound requirement that they felt was necessary to have profitable trading on an ongoing basis. During this time, I was introduced to Monte Carlo analysis. Now, Monte Carlo analysis is basically a simulator which allows you to run a series of random experiments to find out the effectiveness and the profitability of a strategy that you may be developing. And so the key thing that a Monte Carlo analysis takes into account is basically what your starting capital is, what your risk is per trade, what your win percentage is, what your risk to reward ratio is. And then the advantage of a Monte Carlo analysis is that it has the capacity to run thousands, if not hundreds of thousands of trades, and so in doing so gives you an idea as to what you would expect with your strategy if you were following it month after month after month. Now, Monte Carlo analysis may not be applicable to all kinds of trading. So for instance, if you've adopted a particular trading style which is more to do with scalping, then issues of risk to reward ratio and Monte Carlo analysis are not so much relevant, because with scalping, the complete dynamic behind scalping, it's a completely different ball game in terms of what your approach is, how you extract your profits. But certainly if you're somebody that's involved in non-scalping opportunities or non-scalping trading, then Monte Carlo analysis can bring some great benefits to you in terms of really providing a good foundation for you to do further testing on. Now, there are some people who may argue that back testing is completely irrelevant. What matters is how you test into the future, or how you test into a live environment. And I completely agree. I think that nothing is more important than making a decision to do proper live testing. However, I still think that rather than trying to find a light switch in the dark and waste a lot of time and waste a lot of money trying to find what works, but at least Monte Carlo can give you some ideas, it can give you some insights, and it can give you some things to work with for you to then take forward. And so with Monte Carlo, for me, it was a very, very, very important tool at my disposal. And it was Monte Carlo that helped me to really understand the strength of having a high reward to risk ratio. One of the things about Monte Carlo is that when it generates results, it actually gives you, it displays it in the form of an equity curve. And so what I did this morning, I wanted to demonstrate a contrast between a system which is a high win rate system, that it's a system whereby the reward to risk is around 0.3 to 1. So a system like this, especially if we're talking about football trading, might be akin to certain systems I see out there where they talk about backing over 1.5 goals at the beginning of a match. And so normally at the beginning of a match, the over 1.5 price is normally within reason, somewhere in the region of 1.2 to 1.35. Obviously there's a price disparity because it depends on a lot of other variables, but if we just call it 1.3, that's within the grounds of reason, that a lot of matches would be around 1.3 for over 1.5 at the beginning of a match. And so with over 1.5, we know that most games are going to be over 1.5. A vast majority of games are going to be over 1.5, and especially if you pick the right leagues and the right teams. So I ran this simulation for 100 trades, and what I did, I said, okay, the risk is going to be 2%, so we're starting with an equity of 5,000 euros, and we're going to be risking 2% per trade, and let's run this for 100 trades. And these are 6 different simulations. Now what I wanted you to pay attention to is the volatility that you see, and volatility is really just a measure of randomness or variance. And what you can see here is that if you look in the second and third graph, you can see that the equity graph is showing a strategy which has actually a positive motion going forward. So it starts off at 5,000 euros, and after 100 trades it's hitting just over 6,000 euros in both examples. But look at the other 4 graphs. In graph number 1, graph number 4, graph number 1, graph number 5 and graph number 6, after 100 trades you can see that the equity has actually gone down. Graph number 4, the equity it's kind of going through a bit of a roller coaster ride. It's up and down, up and down, up and down. It eventually does go up. Another observation is the fact that with these simulations, it's kind of giving you an idea that after 100 trades, you shouldn't really be expecting your system to generate any more than about £1,000 in profit, because in graph number 2 and graph number 3 you can see that it's actually approaching, well, it's obviously eclipsed 6,100 euros in profit. Now if you're somebody that's used to trading strategies where it's high win rate strategies but where the reward to risk isn't really in your favour, you might be used to this kind of emotional roller coaster of a journey where it kind of zigs. I mean, even the lengths of the zigzags, so the lengths of the peaks and troughs, of the growth and pullbacks, they're quite significant. And when I was trading in my early days, especially in sports trading, I was kind of told, well, this is what we should expect, because of the fact that nothing's guaranteed and we can have these uncomfortable moments. However, I want you to look at the next slide. Now this is actually a simulation of the parameters that I presently work with, where my probability of success it fluctuates between 50 to 60%, but I would say it's 55% is probably the most accurate figure in terms of my monthly win rate. However, I always try to go for a reward to risk ratio where my reward is, if I can get it to 1.8, for me that's ideal. Sometimes it doesn't always work like that because of the way that price works, and sometimes you have to work with the price within a particular range. So my ideal is 1.8. If I can get it to 2, sometimes I can get it to 3 or 4, but on an average I would say it's around 1.7 to 1.8. Now we're doing a simulation again for 100 trades, and I'm still risking 2%. Now look at the equity graphs in this. Apart from graph number 2, all of the other equity graphs seem quite consistent in that they are moving upwards. The growth and the pullbacks are not as severe as what we saw in the previous slide. And also look at the peak. So for most of them, they're saying that after 100 trades, your growth should have been from 5,000 euros up to 12,000 euros and beyond. I mean, graph number 3 is at 16,000, graph number 5 is at 18, graph number 6 has just cleared 15, and graph number 2 has just cleared 6,400. Now let me go back to the previous slide. Can you see the visual contrast? Which one is more volatile? Yeah. Which one has the more accelerated rate of growth? Now, graph number 2 can happen, and that's because of variance, and that's because of randomness. So even with this particular strategy of mine, where the parameters seem to be more in my favour, I can still have 100 trades where I'm actually struggling just to clear sort of, you know, an additional 1,500 euros over 100 trades. But the point is this: what Monte Carlo is showing me is that the parameters are more in my favour with this particular type of metric. Whereas with the previous slide, what Monte Carlo is telling me is that there is more volatility with this particular approach of a high win rate and a low reward to risk. So it's tools like this and principles and concepts like this which helps me to understand why it is that many of the world's top financial traders seem to focus so much significantly on the fact that there's no need to have a particularly high win rate. It didn't make sense to me initially, and that's why what you will find is that many of the leading trend traders, because you've got to realize when it comes to global markets, things only trend normally 30% to 40% of the time. The trend isn't something that happens the majority of the time. And so with trend traders, what you find with trend traders is that some trend traders actually end up with win rates which are 40% or less. Some work with win rates of 25 to 30%, but their rewards are huge. I mean, we're talking about, you know, people that are trading where they're risking 1 to make 10 or 20. And so what you find in those situations is that it's small loss, small loss, small loss, small loss, giant win. Small loss, giant win. And then sometimes you get giant win, giant win, giant win. And so it was this understanding which really started to make me understand that I really needed to change my approach in terms of how I constructed the development of my trading strategies and how I actually implemented them. Now, I think one of the other key things I just wanted to mention is the fact that I do understand that there is a bit of a dichotomy between financial trading and sports trading. In fact, there was something I actually wanted to mention at the beginning of the presentation and I completely forgot. As I said, there's going to be gremlins on this webinar because it's the first time and I'm kind of freestyling it. One of the other things I just wanted to mention is that I am actually from this moment onwards going to use the term speculating. And the reason for that is because I do understand that there are people listening to this that are coming from different backgrounds. Some are traders, some are value bettors, and some are coming from different walks of trading. And also I recognise that there is an argument and a debate about what is trading. Is trading the same as gambling? Is there a difference between gambling, betting and trading? And so in order to kind of not get embroiled in that, so people are asking me, well, you mentioned trading, what was you talking about, value betting? If I use the term speculating, then to me that's an all-encompassing term. So whether you are a value bettor or a trader, if I use the term, or an investor, if I use the term speculating, it covers you regardless, because at the end of the day, what we are doing is speculating based on information. We do not know the future, we cannot guarantee the future, so speculators is the term that I will use. There are additional other components which I use to measure the metrics of what I'm doing. One of them is called expectation, which really measures the robustness of a strategy, specifically how much or how quickly can a strategy rebound from a drawdown. Very important, because you're going to have drawdowns regardless of how well you think your strategy can perform. It's quite interesting. I follow a few people on Twitter, and really just to get an idea as to how different strategies perform. And there was one individual who is running a strategy which entered, I think it was 7 or 8 losing trades in a row, and it was just really interesting looking at how those who had been following him, or how some of those who had been following him, started to respond. All of a sudden he was getting very negative criticism, and all of a sudden people who had called him God and Saviour and all kinds of really colourful terms, all of a sudden now he was the worst thing since sliced bread. And what was quite interesting was the following week he then had 7 or 8 winners in a row, and it was just interesting seeing the responses from people. But expectation is really a measure of the robustness of a system, and these are things that I'm going to go into in a lot more detail on other webinars. And again, one of the reasons why I like high reward to risk ratio strategies is because when you do go through a drawdown, it's a lot easier to it's a lot more palatable to accept it, because of the fact that you know that you don't need the same equivalent of winning streaks in a row to get back to break even. If you're dealing with a system which is which has a reward to risk of 1-to-1, or it has a reward to risk of 1-to-2, which basically means you're risking 2 to make 1, then basically when you have losing streaks, it does take a longer time to get back. Whereas if you've got a system which has, let's say for my system's sake, because I'm risking 1 to make 1.8, I know that if I have a losing streak of 4 in a row, 4 ones in a row, I don't need 4 wins in a row to get back to break even. I may need 2 wins, 3 wins, And so robustness is really kind of measuring how robust your system is in terms of going through the various levels of volatility that it's going to experience in the life cycle of that system. Sharpe ratio, Sortino ratio, again, these are very definitive parameters within financial trading. And what amazes me is how these are not even talked about by people in sports trading, not to the extent that it's talked about in financial trading. There are people that I do know within sports trading that do, especially who are involved in programming, who do take into account Sharpe ratio and Sortino, but I think these are things that we should all be aware of. And at the end of the day, we need to realise that this is a business. Many decades ago, before financial exchanges came into sports, when it came to sports, it was very much just punting. You go down to your local bookmaker and put a wager and have a punt. And I think this is probably one of the reasons why I do sense a difference in terms of approach between financial and sports. Because in the financial world, many decades ago, there were no retail traders. If you were involved in trading, it was because you were a professional trader working for a hedge fund or a prop firm or working in an investment bank. It's been only in the last sort of 5 to 10 years that all of a sudden there's been a generation of retail traders who are individuals working from home trading because they see it as a method of being able to make income or a full-time income. The development with sports is that 10-20 years ago it was just gambling, but in the last sort of 10 years 15 years or so, obviously with the advent of exchanges like Betfair, it basically means that there are people now that they don't have to gamble against the house, because at the end of the day, I don't know what you say, I don't care what you say, the bookmaker is always the house, the bookmaker is the casino. So if you're constantly trying to work strategies which work against what the bookmakers, if you're trying to work a strategy utilizing bookmaker systems, then I don't see how you can win long term. And if you do, you are very much a minority. But with the exchanges, because of the fact that I'm actually trading against somebody else, so I'm buying or I'm selling against somebody else who might have an opposite opinion to me, the exchanges have actually created an opportunity where people can be very successful speculating. And but I think with sports, what happens is if people are coming from gambling into trading, and I'm using trading when I should be saying speculating, but just for the purpose of this demonstration, when people are coming from gambling into trading in sports or value betting, they still bring a lot of that gambling psyche or gambling mentality. And so what we find is that things in the financial world like Sharpe ratio, Sortino, expectation, it's not really something that's focused a lot in sports trading. But anyway, moving on. Again, this trade is quite important because this is demonstrating the streaks that can happen with a strategy. Now, my strategy, as I said, has a win rate of 55%, thereabouts. And one of the things that you can see with my strategy, and this is based on 30 trades for a week. So each week I'm making in it, on average, about 30 trades a week. What you can see is that my strategy can have losing streaks, it can have winning streaks. So within 30 occurrences, you can see that there's a 1.3% chance that I can have 11 wins in a row. You can see that there's a 50% chance that I could have 5 wins in a row. Within a 30 trade week, you can see that there's a 10% chance I could have a winning streak of 5 twice in that 30 trade cycle. You can see that within a 30 trade week I can have a winning streak of three wins. There's a 10% chance I could have that 4 times. If you look at the table below, which is the loss rate, what you can see is that with a 55% strategy, and there's a mistake on the slide because that loss rate should say 45%. So I'm sorry for that. The win rate's 55 and the loss rate is 45. So with a loss rate of 45%, what you can see is that it is within the bounds of probability that I could have up to 15 losses in a row. I mean, it's only 0.01%. Normally within reason, we will probably say, well, judge things more by 1% or greater. So I would be more expectant of my strategy giving me, in a worst case, 9 losses in a row, because 9 losses is 0.95%. However, the fact that that 0.01 is 0.01 and not 0 means that it's still possible within reason that it could be 15 losses in a row. So this kind of helps to manage expectations, so that when things happen, I'm not sitting there thinking something's wrong with my system. Now, if things start happening beyond what you're expecting, then that means you have to then question whether something is wrong with the system, or it could be the fact that the environment has changed. And that happens a lot within financial trading, because you have sideways markets, bear markets and bull markets. It means that if you have a strategy which is very favorable in one environment, it's going to then completely behave differently and show a different level of metrics in the other two environments. And that's one of the reasons why it's important to not overreact when your strategy is actually going through a bad run, providing it's within reasons of what your expectations should be for streaks. So this is what really helped me to move forward, and it was really just a reaffirmation of a lot of the things that I had been taking from different traders within the financial world. I came across a website, and I've put the URL there for you, thebalance.com, and it's basically a website which produces a lot of articles in the area of trading. They actually provided an article which for me just made so much sense and helped me to construct a plan of how I was to move forward. And essentially what they said was that if you could find a strategy where your win rate is above 50%, where your risk to reward ratio is at least 1.5 to 1, where your trading strategy has the ability to give you a minimum of 20 trades per week, and you are adopting a risk management process of no more than 2% of your bank per trade, then what they demonstrated was that you have a system with positive expectancy and a system that will generate you profit on an ongoing basis. Now, it sounds very simple, but what was quite interesting was, again, this emphasis that your reward has to be higher than your risk. Another key thing was the number of occurrences. So it had to be a strategy. It can't be a strategy where you're just trading 5 or 6 times a week or 10 times a week. It had to be a strategy whereby it's giving you enough occurrences to help the expectancy of your system to bear out on a much quicker basis. Because as you know, the less times you do something, the more times that there's going to be variability and randomness and volatility. And we see that many times. I mean, the coin toss is probably the best example of that, in the sense that we know that if you toss a coin, it's a 50-50. But if you toss it 10 times, it's not beyond the realms of possibility that you could get 7 or even 8 heads or 8 tails in a row. But it's still a 50-50 system. But if you were to toss that coin 1,000 times or 100,000 times, what you then find is that the actual results are much closer to what the expected probabilities are. And it's the same thing with trading. You have to trade with enough frequency in order for the positive expectancy or probability to play out in your favour. The other good thing about trading many times a week is that it allows your system to digest those losing streaks. Yeah? And what I mean by that is, because of the way I trade, if I was to hit 6 or 7 losses in a row, normally that would cover a period of 2 to 3 days, because I trade in a particular way whereby and I'll talk about this at another time, where I try to manage my risk in a particular way. However, if I have 6 or 7 losses in a row, normally that will be over the course of, at a maximum, 3 days, or mostly within a 2-day period. What that does, then the other 5 days are normally profitable days, or strongly profitable days. So by the end of the week, even though I've had 2 really bad days or a number of streaks which are on a negative side, it means that still on that weekly basis I may still be quite significantly up in terms of my profitability, because of the fact that I've traded enough times for a mean reversion to take place, whereby I start coming back with positive winning streaks. And so what you need to understand is that if you're trading very infrequently, then you're going to have to, so for instance, if you only trade 10 times a week or even 6 times a week, then it's possible that if you hit a losing streak, that it's actually going to be a losing streak, which means that your week actually ends up being a negative week, because you're not trading with enough frequency for the growth part of your probability process to actually then kick in. So that's why I found it very interesting, this particular article, and risk management no more than 2%. I mean, again, another thing which is very different between sports trading and financial trading is, in sports trading it's normal to be trading 5% of your bank, but most of the time in financial trading they say 1%, 2%, if you're pushing it 3%. And the reason for that is because of the fact that if you hit nasty streaks and it reduces your bank balance significantly, it can really then have a disruptive process as far as your mental state's concerned, where you then don't take the next trade you should, because you're completely worried about your bank balance being completely reduced. And so that's why in financial trading, I do 2%, and I think I'm being aggressive doing 2%. Normally I should only be doing 1%, but what I'm trying to prove is how quickly I can scale up a bank of £5,000 onwards. So these are the metrics that I'm presently using. So my win rate is 55%. On average, my reward to risk is around 1.8. The strategy that I have is normally on average about 30 trades a week, and so far I've been using a fixed stake size of 75 to 100 pounds. Now somebody asked a question which I'm probably going to address a bit later on about, well, is this strategy something that's workable all year round? And yes, it is. Even in the month of June, where we actually have a World Cup, it's still workable because of the fact that there's other leagues that I can trade, and when I trade a particular nation, I normally go 2 levels deep in terms of the leagues. So I'll normally go Division 1 and Division 2. I won't go, the only time I'll go further is if it's the English League, German League, Scottish League, but I wouldn't go that lower in terms of other leagues, because then the liquidity is just completely abysmal. And so because of using these particular parameters, this is what has happened. So started the 13th of March with a bank of £5,000, and by the 3rd of May, which was yesterday, I'd actually made £6,800 profit. So potentially my bank would have grown to 11,800. Now the reason that I've said potentially is because I dipped into my account to take some money out because I had particular expenses that I needed to cover. But if my bank was now 12,000 or 11,800, then my liability per trade would obviously be a lot higher. I probably would now be trading probably in the region of about £160 liability per trade. But right now, because my bank has sort of gone back down to £5,000, I'm still trading a fixed size stake, which is normally £100 per trade. Now I want you to look at the equity curve. Now people are saying, gosh, how can you have so much growth, and is it a scam, and we don't understand it because that's not how things should work. Well, look at this equity curve compared to this equity curve. See, what I'm trying to demonstrate and what I'm trying to explain is that if things are done in a scientific nature or done on scientific processes, there really shouldn't be any shock or amazement at what's happening, because all one is doing is demonstrating what is supposed to happen. Now, I could have had an experience similar to graph number 2, but because the Monte Carlo is telling me that most of the time it's going to be not number 2, then that's why I'm not really surprised when I see my equity curve here in terms of the profit that's been made. So this equity curve isn't showing the balance, it's showing profit made from the 30th of March. The second graph, the bar graph, is a very powerful way of me being able to understand the relevance between winning days and losing days. Do I have losing days? Yes. But look at how the losing days are in comparison to the winning days. You can clearly see that there's 1, 2, 3, 4, 5, 6, 7, 8. There's 9 losing days. And there's probably like 18 winning days. So basically, on a daily basis, I've got this, I think the percentage is somewhere in the region of about 66 to 70% most of the time. I've got a winning day. And then the other thing to bear in mind is that most of the time, my winning days are larger in terms of value than the losing days. And so what I'm trying to demonstrate here is I've got a system which only wins 55% of the time. But look at how strong the metrics are, or look at how strong the evidence. The empirical data is showing us clearly that it's a system with a positive expectancy. So in terms of how I trade, now, again, what I'm trying to say here, and if somebody misinterprets my words, either you're willfully ignorant or dangerously stupid. I am not saying that the way I trade is the all be end all of trading. All I'm saying is that I have found a particular method which works for me. How this method works is I always trade where price is within a particular range. Why? Because I know that if I place a trade in that particular range, it's going to give me a lot more profit than if the profit comes through than what I would lose if the trade lost. And so I always go in around 1.65 to 1.2. Now the reason there's variation on that are a lot of factors that I can't go into right now. But this explains to you why you wouldn't see me trading. For instance, I remember when I started trading and I used to do labour draw at the beginning of a match. And so if I put on £100, if I put on £100 to win as my profit, for my liability on the trade was in the region of about £400. Now, obviously, it doesn't have to be a £400 loss, because you can actually close your position to ensure that you're not losing as much as £400. Yeah. But one of the things that used to happen when I used to trade so early in a match or in the middle of a match is the fact that sometimes I had situations where the market would suspend, whether they'd lost a feed or in some cases something happened in the game was suspended, or something happened where it was suspended more than the norm. And then when the market reopened, the price had actually shot past my stop loss, or shot past the point where I normally would have closed out for a loss. And so the reason that I trade the way I trade now is because when I place that trade, I don't care. I don't have to worry once I place that trade on. I don't have to worry about anything to do, well, if the market's suspended and it comes back into operation, it's going to shoot past a particular point. When I place that trade, I place that trade. And I'm talking trades when I should be saying speculative, but anyway, I'll have to deal with that. Obviously, a part of the process is identifying where goals are going to come. And I use a combination of pre-stats and in-play momentum. I use pre-stats because pre-stats are very good at helping you to sieve out what is more likely from what isn't likely, but you can't depend on pre-stats alone, because how many times have you actually seen two teams from Dutch Division 2, Turkish Division 2, where it ends up 0-0 or 1-0? Yeah. So for me, in-play momentum is just as important, because in-play momentum is really just a reaffirmation of the pre-stats, and you're looking for a correlation between the two. Now, there's other factors I take into play, and those other factors I would never ever talk about them, because it's just, I wouldn't say proprietary information, but it's just things that I've learned my way, and I feel if I told everybody, then it probably would impact price if everybody's trying to do the same games. That's why I don't provide tipping services, because I want to make this last as much as I can without the market starting to be impacted. Yeah, and I'm not saying this from a boastful, egotistical perspective, but it's just the fact that there's certain things that I've developed, there's certain tools I use which are custom tools, so those custom tools anyway could only be used by me. So but really the core is the pre-stats and the in-play momentum. Risk management is important, because risk management helps to minimize volatility. You know, I used to think, well, if I get up on a Saturday morning and find 50 games and trade every one of them, that by the end of the day I'll be in profit. And it just doesn't work like that most of the time, because there's so many things that happen whereby the price might not be where you need it to be, the game that you thought was going to be in play is suspended indefinitely, and there's just so many factors. And also you've got to also understand the wear and tear on your mind. You've got to also understand the fact that most of us do not live in isolation, we live with a family. And so there's other things, you know, the phone rings, you need to go to the toilet. So for me, I realise that I only work best if I'm trading, you know, 4 to 7 or 4 to 8 games at most per day. Sometimes on a Saturday I can do like a morning shift, and if my schedule is clear in the evening time after having some time out in the afternoon, I can come back and do an evening shift. But that's only mostly on Saturdays, and I don't do that frequently. Again, I think back testing is very important, because you need to have confidence, or some confidence level, that what you're going to go into a live environment with actually has legs behind it. It's also got to be scalable. Yeah, it's got to be scalable without any psychological baggage. So what I mean by that is, you know, people that are risking 3 to make 1 or risking 4 to make 1, yeah, you might find it really easy and not too much of an issue risking £30 to make £10, or risking £40 to make £10, because you've got a high win rate system and you're thinking, well, the win rate, even though my risk reward isn't that great, the high win rate over time will help me out. Have you thought about what happens when you try to scale that up? So you might find it easy to risk £40 to make £10. Yeah? But what about risking £4,000 to make £1,000? You know, how difficult would you find it making that transition? And that's why I keep talking about being able to have a system that is scalable without psychological baggage, because as you start to scale up your systems in terms of position sizing, your mind is obviously going to start presenting challenges, because of the fact that you are now starting to increase the risk. Yeah. So you've got to make sure that if you have a system that's scalable, that any psychological baggage is minimized as much as possible. And that's why when you're scaling up, it shouldn't be, for instance, I'm presently trading £100 in terms of liabilities. When I move up, I'll probably move to 125, then to 150, then to 200. But back in the day, I would start with £100, and then when I thought it was working, I'd go up to 200. And then sod's law, when I go up to 200, my first 3 trades would be losing trades. And then I would think, oh, trap. And then I would be like, I can't take that next trade at £200 liability. I'd go back down to £100. And then my whole trading analysis is completely skewed, because I'm using different lots or using different position sizing, because one minute I'm trying to go big, but the next minute I get hit with losses, so I go back low, and you're just all over the place. So in terms of consistency, it's so important to do things gradually over a period of time. And you understand that when you start understanding how your brain works, and the fact that you've got a protective mechanism in your brain that tries to act instinctively to protect you from danger. So again, what I've recognized is that systems that are counterintuitive are the ones that bring better profitability. But doing things counterintuitive is something that goes against the grain. I mean, it's not sexy telling somebody that you lose more than you win, or that, you know, that out of 10 trades you're going to probably lose 5 trades. It's not a sexy, and I can understand why system developers most of the time will sell flashy marketing headlines in terms of 70%, 80%, because we're trained from a very young age from the educational system to believe that anything which is above 70% is credible, whereas anything that is below 60, you know, you're going into sort of D range, 50% E range. Yeah. But trading, it's a completely different environment. And for me, personally speaking, I kind of found that I had to really understand why it's important to be counterintuitive, rather than just going along with the herd mentality of going with what people would expect to be the best way to trade. The other thing that I wanted to talk about is internalizing probability theorem. It's important to understand it's not just about understanding, you have to internalize it. And I see so many situations where people come to me and says, well, what you're talking about is nothing new. It's nothing new. But yet those same people are still not doing what I'm talking about. They're still doing other things with other systems and not internalizing the very thing that they're accusing me of. What I'm talking about is not new. What I'm talking about is not new. It's not new. But how many people are actually internalizing some of the things that I'm talking about? And you can always tell when somebody isn't living what they think they know, because I mean, I saw another about a week ago, somebody had come onto a forum and was basically saying that they were really at their wits' end because they'd been running a strategy which was delivering terrible results, and they kind of explained in some detail that their strategy, it was a strategy with a very high win rate, and even though they were risking £40 to make £10, they couldn't understand why week after week they were broke. And the person that responded said to them, well, keep trying, things can change over time, and maybe what you need to do is actually reduce your position sizing so that it makes you a bit more comfortable. And the response was just, and this is somebody I know personally that has actually in the past always accused me of talking about stuff which isn't really that new anyway. And I'm thinking to myself, well, if you believe the same thing I believe, why wasn't your response to that person, forget the high win rate, forget at the minimum in terms of your risk reward, make it a 1-to-1. Your risk and your reward is imbalanced, and it's only going to lead to emotional trauma over a period of time. But that's not what they said. So that for me is an example that I keep finding of people ready to say, well, what you're saying isn't new. Well, if what I'm saying isn't new, why don't you do what I'm saying and prove the results and show people that it actually works? And so that's why I'm saying internalizing it is so different. And I'm guilty myself. I used to know it. I used to know the language once I started to become familiar with probability theorem. I knew the language, I could talk the talk. But there is such a big difference in translating that knowledge into a emotional and a mental acceptance of that theorem, and that you do it and you follow the strategy and you take each trade, even though there are certain times I take trades and I'm like, oh, I don't want to take this trade because I've just got this feeling that it's not going to work, and it doesn't work, but I've got to keep taking the trade because I have no idea whether a trade is going to be successful or not successful on a trade by trade basis. The only thing that I can do is make sure that I'm taking at minimum 30 trades a week, minimum 100 trades a month, so that over a period of time I can clearly see how it is a profitable exercise. But on a trade by trade basis, if you completely do what I did in the past, where I used to have anxiety attacks, I used to worry and I used to hesitate about whether I should take the trade, and then I was hesitating, or as I'm about to place the trade, I think, let me just do a bit more research to find out whether this trade I should really, let me just check on the teams and their stats again, and before I know it, the market suspended, and had I taken that trade, it would have been a success. You've got to take each trade as it comes for this process to work. These are some of the sources that I use. I use a lot of sources, but these are some of the key ones. So as you can see, I'm not using anything that you wouldn't really know about. I'm sure most of these you will have known about them. And obviously I've got my own internal tools and my own algorithms that I use, but I feed it from information. And quite a lot of these websites here will allow you, if you're a technical phobe like me, they will allow you to set up APIs whereby you can actually automate pulling down the data, as opposed to having to manually go in and look what you're looking for. As I come to the end of this first webinar, Mark Douglas, who died a few years ago, is one of the best exponents of probability theorem that I've ever come across, in terms of relaying it to me in a way which made sense for me. And I've obviously got both his books, but Mark really was instrumental in helping me to understand how there's no point making any judgment about the trade that you're getting into. If you've done your homework and you've selected a trade, you've got to take it. And he was very instrumental in helping me to understand that one of the things that prevents people from being able to be successful in their trading is the lack of consistency in terms of how they approach things. And I'm going to be playing some clips from Mark probably in a second webinar, but I just wanted to highlight how a lot of what he talked about really helped to bring me out of the gutter into a situation where I literally had to face probability theorem and face the fact that I couldn't predict trade by trade what was going to happen. I think that was probably one of the key issues for me. I'm a very, very I'm a person that always wants to know the nitty gritty of how things are. Yeah, so give me a remote control. I'm not really satisfied in knowing that if you point it towards a TV, it turns a TV on. I want to know, well, how does it do it? What is it emitting that's making the TV recognise it? And with trading, what I've realised is that when it comes to the science of probability, you just have to accept that probability is probability. If you try to dice it up, slice it up, and it will actually become so exasperating that it will actually do a lot more psychological damage. And I've seen it happen so many times in my trading, whereby I may start a particular week of trading, knowing that I'm normally doing about 30 trades a week, and I start off with like 7 trades. My first 7 trades are losses, and all of a sudden I'm worrying. Panic station is up. I'm thinking to myself, oh my god, something's wrong. But by the time I hit the 30th trade by the end of the week, I'm still 55% win rate and I'm still profitable. And I'm like, well, how on earth could that have happened? How could I start off with 6, 7, 8 trades in losses in a row, and then somehow probability kind of does a mean reversion all of a sudden, and you could really spend your whole lifetime in anxiety trying to understand how it works. Sometimes you just got to reach a stage where you know the science works, just do what you have to do and let the science take care of the process. Yeah? And that was where my comfort factor came, when I literally gave up and said, I hold my hands up, I'm not going to try and figure out the granular details of this thing anymore, because I've spent too many years, lost too much money, and been mentally scarred. Let me just do what I need to do and trust that probability works. Providing I apply proper risk management processes, providing my research is sound, providing my hypothesis is sound, because we're basing everything on a perception that what we're doing is sound in the first place. So there's no point trying to apply probability theorem and your theory or hypothesis is already suspect, then it's not going to work anyway. So we are making presumptions that we've got something that already has positive expectancy. And if Mark Douglas is somebody that you don't know, have never come across his work, go online, do your research, you'll see that he's very much somebody that's got a very, very strong presence within the trading industry. So I'm going to end this webinar just by addressing some questions that came through. And the first question was, hi Mel, hope you're well. I've been an avid follower of your progress and have read your website word for word 3 times, now in addition to subscribing to your Twitter notifications, as I really want this to work for me because I love your approach and what you're doing. I've done a month trial equating to about 120 trades, but only achieved a 33.33% success rate. So 2 questions I have for the webinar are as follows. Well, before I even answer that question, your questions, you've talked about what your success rate is, but you haven't told me what your risk to reward ratio is. So I can't really understand. You've given me some good information and you've told me how many trades you're doing and the win rate, but you haven't told me what your risk to reward ratio is, and also what your position size is, whether you're trading fixed stakes or percentage base of your bank. So that would help. But anyway, I notice you pick matches often involving the same teams. Is this because they regularly trend to score or concede late? However, you don't always trade on their games. How come? My trade selection process isn't really based on team, it's based on stats. So if a team has strong stats, it's more than likely that team is going to come up time and time and again. However, I pick trades where both teams have the favourable stats I'm looking for. So if you see me pick, Jenabuk from South Korea, and then you see that they're playing another time and I haven't picked them, it could be the fact that either the second time round, their stats married with the stats of the other team simply fell out of the parameters that I'm looking for. Yeah, so I hope that explains. You mentioned before you don't watch the matches, you watch the price instead. Can you elaborate on exactly what you're looking for? Yeah, the reason that I do that is because I find that there's a lot more emotional involvement. If somebody misses a sitter, or it hits the post, or the referee makes a stupid decision, then I find that it starts to breed anger. But if you're just looking at price, you're almost like a step detached away from that whole emotional involvement. But in terms of price, what I'm looking for, it's really difficult trying to sort of define it, because it's if you can imagine, when there's price decay, when there's a decay of price towards the end, if you can imagine like the equity curve, but a reverse of an equity curve where price is coming down, it doesn't necessarily come down in like a slanted straight line. There's ebbs and flows based on what's happening, and so what it is, the algorithm that I use, and this is something that I've developed over time, and it's only got more effective with the more information that I'm putting into it. But essentially what I'm looking for are for certain incidences where price might stabilize for a while, because the market is obviously reacting to what they're seeing. So if price is not coming down as fast as it should be, or if it keeps having these little plateaus of sort of consolidation before it moves down further, then I know that these are signals to me that there is an expectation that something could happen. And that's how I base things on. Yeah, so it's basically reading price as it's coming down, and being able to build yourself a way of understanding what's happening without you having to be emotionally involved. So I hope that helps. And it doesn't work all the time, and that's the thing. If we're trying to do this because we think that we can be 90% right, then we're going to be woefully wrong, because there's many times I'm wrong. But what I'm doing, all I'm trying to do is just give myself enough of a win rate to maintain to maintain that risk to reward profit factor, because I know that I don't have to be right 70% of the time. I can be right 55% of the time. So all we're looking are for these small edges here and there to sustain what we're doing. So thanks for that question. Can you explain how you pick the matches? Is it with just stats or watching a game? I've just explained that, so it's a combination of both. I know some people that will just base it on pre-match stats. I know people that will just base it on in-play momentum. I base it on both. Hi Mel, hope webinar goes well. Was wondering how far away from Psychoff your method and entry time is. If people online don't know, Psychoff is somebody in the industry who's like a super heavyweight. There are quite a few super heavyweights in the industry when it comes to sports trading. Psychoff is one of them. I certainly know that Ian, who runs FTS Income, is one of them, because I've seen what he earns on a Saturday. Sports Trading Pro, or Sports Life Trading, or Sports Trading Pro. So these are what I call super heavyweights. These guys are the guys who very easily make thousands of pounds a week, or a day, and Psychoff is one of them. But Psychoff runs a tipping service. From what Psychoff does, Jeff, Psychoff's approach is slightly different to mine, because I think Psychoff normally goes in at around 75 to 78 minutes, and at that time price is probably even, so it's probably risk reward of 1 to 1. Whereas I go in a lot later. I'm going in sort of around 83 to 88 minutes because I get a lot better favourable reward for my risk. I suppose our strategies are quite similar in that we recognise that we're trying to trade in a market where there's an expectancy for goals. So I think there are similarities there, but then in other cases there are slight differences. Also, I'm not sure how Psychoff does his trade selection, because there are certain games that he tips and I'm like, there's no way I would have traded that game. But I'm sure there's certain games I trade where people are like, well, there's no way we would have traded those games. So, but hopefully that answers your question. Hi Mel, I was meaning to ask, are you expecting some sort of downturn any time now? I remember your win rate is 55 to 60%, but the last 1 to 2 weeks you barely had a loss. What sort of correction are you anticipating, or are you confident of avoiding it? Well, in the last 2 weeks I have had losses, and this is something I wanted to explain. When you see my daily results, you have an opportunity to break it down and look to see, well, what contributed to that daily profit. So most days I think there's very few days where I don't have a trading loss, but providing I'm trading 3 to 5 times a day, and providing that my reward to risk is favourable, so at least 1.5, better still 1.7, 1.8, then I can have 5 trades in a day, 6 trades in a day, where even if it's 50-50, because of my reward to risk is powerful, it means that I'm still coming out with profit. Yeah. If your question is more in regards to daily losses, why have I not had many daily losses? Well, we go back to here. This is why I don't have many daily losses. Now, graph number 2 clearly would probably demonstrate having a lot more daily losses than I would want, but certainly the other graphs are showing you an equity curve where there wouldn't really be many daily losses looking at an equity curve like that. So I hope that answers your question. So it's not that on my website there's a simulation which I ask people to participate in, where you're using the website random dice roll online or something like that, because I want people to actually see that what I'm doing, it's not rocket science, and it's not something that sort of has an esoteric kind of, oh my god, this is like a holy grail feel to it. It's just demonstrating how science works. And when you do the simulations, so I think I say take a 9-sided dice, because with a 9-sided dice you can represent a 55% probability by, if the dice roll is anywhere between 1 to 5, with 6 to 9 being losses and 1 to 5 being wins, and that the 1 to 5 represents having a 55% probability of win. And when you do the simulation, I did a simulation, and when you actually look at it, it's online. When you do the simulation, look at the amount of losing days. You can see that the losing days are far and far between. Yeah. So when you see that with the way I trade, it shouldn't really be a surprise, because the simulation is already demonstrating what you should be expecting. It's not to say that I can't have drawdowns. If I did have 2-3 days of negative daily results, that wouldn't be a surprise, but when they do happen, it's so far and in between. So hopefully that answers your question. What did your April win rate look like? It's 55%. So in ending this webinar, this is the website to contact me on. My website, www.scientiatrading.com. You can contact me at admin@scientiatrading.com. My Twitter handle is @scientiatrader. Scientiatrading.com. It's not a website to share my results and be egotistical and say, hey, look at me, look how well I'm doing. It's really just to demonstrate that a scientific process that I have, which isn't new, Again, let me demonstrate and emphasize it's not something that's new, it's not something that I've found. All I'm doing is taking information that was taught to me in the financial industry and applying it to what I know within the sports industry, and it's given me consistency in terms of my results. And what I'm trying to demonstrate to people is that you can win, you can be profitable. I could easily have put 10, 15k into my bank and start showing you daily winnings of over £1,000, but I just felt that for most people that are trading, you've probably got a bank which is between £1,000 to £5,000. And so what I'm trying to do is kind of bring a sense of realism in terms of expectations, because if I start showing you £1,000 a day wins, while it can be motivating, I didn't want to sort of create a scenario where people are saying, gosh, look at him and I'll never be able to get there. But certainly if I kind of scale it back to a £5,000 bank, then probably people are a bit more comfortable or can resonate with that a lot more. So I will continue to do these webinars on a weekly basis. Please give me your feedback. Just to show you how basic it is, I'm actually using a normal headphone. I'm not even using a sort of proper microphone, it's just a normal headphone that I've turned into a microphone. So if you do detect some feed, it's probably because of that. And as I get familiar with webinars, I'll spice it up where I can do some more in live demonstrations rather than just being static slides. But again, thanks for your support and thanks for listening, and I'll see you again next week.